Tapering, in the context of economics and monetary policy, refers to the deliberate reduction in the rate of asset purchases by a central bank with the aim of gradually winding down its quantitative easing (QE) program. QE is an unconventional monetary policy tool used by central banks to stimulate the economy and combat deflation or recession. It involves the purchase of financial assets, such as government bonds or mortgage-backed securities, to inject money into the financial system and lower long-term interest rates. The decision to implement tapering arises when the central bank believes that the economy has sufficiently recovered from a downturn and is showing signs of stable growth. By reducing the pace of asset purchases, the central bank aims to normalize its balance sheet and transition away from the ultra-accommodative stance taken during the crisis. Tapering is a delicate process as it must be carefully calibrated to avoid disrupting financial markets and derailing the economic recovery. Announcements of tapering can cause fluctuations in asset prices and lead to uncertainty among investors. Central banks, therefore, provide forward guidance and communicate their intentions well in advance to minimize surprises. During the tapering process, the central bank gradually reduces the amount of assets it purchases each month until it reaches a point where it no longer engages in QE. The timeline and speed of tapering depend on the economic conditions and outlook. If the economy faces headwinds, tapering might be slowed down or put on hold. One of the primary concerns during tapering is the potential impact on interest rates. As the central bank buys fewer assets, the excess liquidity in the financial system diminishes, which could lead to an increase in long-term interest rates. Higher interest rates can dampen economic activity, especially for interest-sensitive sectors like housing and consumer spending. To mitigate the adverse effects of tapering, central banks may adopt other monetary policy tools. They can maintain a low policy rate, like the federal funds rate in the United States, which influences short-term interest rates. Additionally, they might use forward guidance to reassure markets and influence expectations regarding the future path of interest rates. Tapering can have global implications, particularly for emerging market economies. As central banks and advanced economies taper their QE programs, capital may flow back from emerging markets to safer assets, causing currency fluctuations and financial volatility. In conclusion, tapering is a gradual reduction in the rate of asset purchases by a central bank, signaling an eventual end to its quantitative easing program. It is employed when the economy shows signs of recovery and aims to normalize monetary policy after a period of crisis. Careful communication and calibration are crucial to managing the potential impact of tapering on financial markets and the broader economy.